If your clients asked you about the 50-year mortgage, would you know if it's good or bad? Watch this video and I'll lay out the pros and cons. All right, y'all. So I did a training yesterday with my agents in one of our team meetings, and we're hearing that chatter, right? We've seen it all on social media. We know realtors love sharing the same topic like wildfire. So understanding the 50-year mortgage is something I want to explain to y'all, because maybe you've done the research and you know, and you've got an opinion on it. Cool. Drop that in the comments. I'd love to know what your thoughts are on the 50-year mortgage. I did a little bit of a deep dive. Not a mortgage lender, so not trying to get into all that stuff. I do own a mortgage company, but I don't know that much. And I'm going to look at my slides on the left because I did this yesterday, so why recreate the wheel? So if you see me looking over a little bit, that's what I'm doing. So the 50-year mortgage sounds cool, right? I don't think it does. So let's break it down. What exactly do they mean by a 50-year mortgage? Well, honestly, it's 50-year mortgage. It's 600 payments. 600 payments, which, well, fine. And the gist of it is what the government's saying is it's going to reduce the amount of the payments, so therefore more people can afford housing. So it sounds like it's going to fix a problem, but will it really fix the problem? And is it really going to be that beneficial? The best part about this is obviously one of the fair housing rules is we can't discriminate based on age. So you could be a 90-year-old, and if you can qualify for the mortgage, you can get a 50-year loan, which is just crazy to me. I don't think we should ever not follow fair housing, but like homeboy ain't gonna live to 140. So that's how long they could keep this thing. And basically what they're saying is the payment should be much lower. They should qualify more buyers. It should help with the housing market. But the cons, some of the cons are the interest is gonna be paid so much higher. And it's going to be slower to build wealth. One of the best things that we have in America, as you know, because you're probably a real estate professional watching this, is our generational wealth. We get that through housing. We get that through buying a house, natural appreciation. Fortunately or unfortunately, we either sell it or we pass away and we pass it on to our kids. That is how we've built wealth in this nation. And that's why the housing market is so incredibly important to the success of our country. But if it takes slower to build it, is a really good thing. And again, they're marking this as a solution for affordability, but it has a lot of long-term risk, right? So I've got a chart. It should pop up on the screen. I did it yesterday. Again, not a mortgage lender, but I just took this scenario of a $300,000 house at 6% interest. So you got a 15-year loan on a $300,000 house at a 6% interest rate. Just keep it simple. Your monthly payments can be $2,500-ish, right? But you're going to pay an additional $155,000 in interest on that $300,000 house. So in essence, you're going to be spending somewhere around $455,000 on a $300,000 house. It's just the cost of doing business and buying a house. 30 years, same thing, 6%. You're getting around an $1,800 payment. So $600 cheaper for twice as long of a loan. And you're going to be spending $647,000 on that $300,000 house. Not that cool. Now let's bring in the 50-year. 50-year house, you're going to be making a payment around $1,580. So you're going to save around, I don't know, $220 a month in payment if you did a 50-year. But you're going to spend almost $947,000 on a $300,000 house. Guys, and it's just hard to fathom, right? Because yeah, sure, and this is all if the interest rates all stay at 6%. But we know typically, depending on the day, 15-year rates get a little bit lower than a 30-year rate. And also what they're saying is for the exposure of the banks to give a loan to a person for 50 years and hoping they don't default on one of 600 payments, they're probably going to increase the interest rate as a way of mitigating those losses. So really the savings, if they go up half a point, they're going to eat up the savings. So is it really worth it? You're paying almost triple for a house if you had to get interest rate on a 50-year loan. And then you might say, well, it's cool at 50 years and you pay it off, let's say it's average of 3% appreciation year over year. Well, cool. If that's the truth on a 15-year loan, on a 15-year loan on a $300,000 sales price, you're going to be at $467,000. Your house should be statistically around $467,000 in 15 years. On 30 years, if you buy today for $300,000, in 30 years, it'll be worth about $728 on natural, just trackable appreciation. On 50 years, it'll be worth 1.3. But most likely me at age 42 right now, I'm not going to see the end of this thing getting paid off. And the last thing I want to compare. So by year 30 of a 50-year loan, so I want to take a 30-year loan, which we know will be paid off in 30 years, and then take the 30th year of a 50-year loan and compare them. The buyer will have spent $488,000 in interest and will still owe $220,000 in principal. They will only paid off $80,000 in principal per this amortization schedule in 30 years. 80,000 paid off in 30 years. That's not good, because we all know that when we get a loan, the interest is paid up front. So we're paying all of that up front. So in 30 years, you're only going to pay off 80,000 in principal. So guys, that's not good. And also, that's not going to help people be able to resell their house. If they're only paying off 80,000 in 30 years and we have a down market when they're going to sell this house, they're upside down. It's actually going to lengthen the tenure in a house. 2025 statistics that just came out from NAR stated that the average tenure in a house right now is 11 years. I think that age is going to go up because they're not going to have as much equity to sell. The reason people like to move every, 7 to 11 years, depending on what you want to read, is because they build the equity. And they take that equity and then buy the next house. And they take that equity and buy the next house. That is how they get their down payments for the bigger houses. And if you don't have that appreciation or that equity, you're not going to be doing it. So I don't see how this is a really good idea. But let's look at some pros and cons for borrowers and agents. The pros for borrowers: easier qualification because it should be less payment over longer periods. They might be able to get larger budgets. You might be able to budget up if everything were the same. But if they're going to increase the interest rate on a 50-year loan to mitigate the losses, if they had them, it may not be any different. The cons: huge interest rate expense, slow equity build, and less wealth retention. The real estate professional, what's the pro for us? It could expand buyer pool. We know all news is good news. So if people think that they can get a good deal or this loan or this interest rate is going to be helpful, they may get off the fence. It may increase market activity. It might, maybe in the higher ends. The cons: potential price inflation, lower repeat business, and reputational risk. Meaning, let's say that somebody actually decides, say it is a better deal to get a 50-year loan because they can afford more. Well, then we're going to have a bunch of people getting off the fence going after a certain demographic of houses, which is going to drive up supply and demand and therefore drive up price, which is the inflation part. Let's see what else. The tax credit, right? So I also wanted to go in and decide, would it be better to do a 50-year loan for buyers to get the market spurred, or would it be good to do a tax credit? If any of y'all watching this were in the market in 2008, right, and which I was since 2006, there came out with tax credits. Some did them state, some did them federally. I can't remember all the details, but I do remember like the first one was like around 8,000 and it was not forgivable. You had to pay it back if you refinanced or sold your house. The next year it was like 10,000 partially forgivable, and the third year is like 15,000 forgivable. So the people in the third year really got a good deal. The ones in the first year, they got kind of screwed. But I was like, what if we just did a tax credit? Would that be better? And what I kind of came up with, and again, this is my opinion, one, it will be a direct market stimulus. It will increase transactions if there was a buyer tax credit. Now, I did not, when I put this into AI to kind of help me figure out the thought process on this, I didn't put an actual number in there. But it did go back and research and saw that we did have an increase in buyers when there was a tax credit. It didn't add long-term debt to the buyer, so that's good. It's not like a 50-year loan where they've got to be in debt for 50 years. So it was quick and it wasn't harmful to the prices. We didn't see prices jump. Now, I think some sellers did increase their sales price by that amount. Because like, hey, if you're getting 15 grand, I'm going to charge 15 grand more for my house. But there's no statistics on that. And they're saying the tax credit supported a healthy and immediate buying power, like instant, here's your credit, go. Now, the 50-year loan, which is better? Well, that creates more qualified buyers, but huge total cost. Because a 50-year loan, like they've got to be able to afford it still. They still got to go through all that. It may inflate prices if supply doesn't keep up. And we're already 1.1 million houses short, or 1.1 million doors short right now. And there's long-term challenges for homeowners in the market health. We don't know what the market will look like. We know what a 30-year looks like because we've been doing it for decades and decades. I'm not sure what the 50 years are going to look like. Are we going to have a stall? Are we going to have a lack of supply and demand? Are people not going to move? That's the unknown. So it appears on the surface that a tax credit would be a much, much better way of doing this than a 50-year loan. Now, the negative is the government would have to actually give that money as a tax credit, whereas a 50-year loan is actually still on the borrower to get all that in the down payments. So your key takeaways, right? So when they're talking about 50-year loans, you're at a cocktail party and like, hey, I heard about that. What do you think? Well, take this for consideration. It weighs the upfront payment relief against long-term cost. So yes, they may have a smaller payment, maybe, if the interest rates are different, but the long-term costs are going to be far, far more expensive. You need to educate the buyers about the decades-long financial outcomes. If you're only going to pay off $80,000 in equity in 30 years, and let's say they have realtors that they hire and all the closing costs, that can get eaten up pretty daggone quickly. Also, you've got to recognize how market stimulus approaches affect supply, pricing, demand, all of that stuff. If you're in a luxury market, this probably has nothing to do to help you. Or maybe it does. You really got to look at your market and see how that does. I know there are some private banks out there that have been doing longer 40, 50-year loans because things are so expensive in certain markets that that's the only way they can get people qualified. So maybe if you're in those markets, this doesn't sound like a big deal. If you're not, maybe this is one of the markets you need to look at to see how it's affected them. And then, take a look at policy initiatives, tax credits, down payment assistance, stuff like that, that could offset the long-term loss and get your buyers in the house without all that debt. So I know this is kind of an exhaustive approach. I just want you to be educated. I want you to have the talking points. So when people ask you about this, we're not like, hell yeah, that's a good idea. It may not be. And I think my answer would be to everybody, I think it depends on the situation. It depends on the details. On the surface, it looks great. I think in the details, it's not going to be that good. We all know the less interest we pay is the more money we keep in our pockets. So I hope you enjoyed this video. I'd love your comments. I'd love to know what you thought about the 50-year idea. If you think it's good, if you think it's bad, or if you've got other counterparts, I want to be educated in this too. So hopefully you took something from this, and we'll see what happens. We'll see if this thing gets passed or if it doesn't.